Hello everyone. I wanted to go over a series of transactions. The book has it, but more than anything else I wanted to go through one by one so we could get some reinforcement on some of the concepts. Notice that everything revolves around assets equaling liabilities plus owner's equity. You can see here assets, liabilities, and stockholders' equity. Notice how we keep everything in balance. We start on February 1st with the good doctor investing $100,000 in the business. Well, if you're investing money into the business, that means the business's cash account has to go up. When the business that is separate from Dr. Luke gets cash, then it basically has common stock. It has someone that has invested in the business. And you will notice, if I can get it to work, there we go. You can see the $100,000 of cash coming into the business and the common stock that is recognized saying, hey, there's someone out there that invested in the company. Next one, the business borrowed $50,000 signing a notes payable to the bank. Well, here it basically tells you that notes payable are going up, which is right here, because you're signing a notes payable. And then, of course, if you borrow money, cash goes up by $50,000. Cash going up by $50,000, then we owe $50,000 in notes payable. The business paid cash. Remember, please get your cash entries right. The business paid cash for land costing $105,000. Luke plans to build an office building on the land. Notice that this last sentence here doesn't really have a whole lot of bearing. Plans to do things are not anything you make an accounting transaction with. So here we have you pay cash, so cash is going to go down by $105,000, and you're going to increase land. Notice that cash goes down and land goes up, and that's an up and a down on the left-hand side. So again, we remain in balance. The business purchased medical supplies for $1,700. It doesn't. It says pay careful attention. It says purchased on account. So if you purchased on account, then you've got an accounts payable. If you sell on account, in other words, when you sell on account, you have an accounts receivable, because when you sell, you expect to receive something. Here you're not selling, you're purchasing, so you expect to pay something. So you'll see accounts payable go up by $1,700, and then medical supplies will go up. Medical supplies up, but we also owe it. Remember, accounts payable is short-term debt in the next 30 days. Dr. Luke officially opens for business. As we've said, this is not an accounting transaction, this is just an event. No entry. Dr. Luke treated patients and earned, here's a big clue here, earned service revenue, that means you're going to book revenue, of $5,600, receiving cash for half the revenue earned. So you earned $5,600, but you didn't receive cash of $5,600, you received cash for half of it. So you will see here half of it as cash, half of it as an accounts receivable. You expect to receive it in the next 30 days. And then service revenue, because this is what you do, you book revenue when earned. The business paid employees salaries of $2,300 for the first half of the month. You'll notice that business paid means cash is going down. So cash is going down, and salary expense, in this case retained earnings, is going down. Salary expenses are going up, and the effect of expenses going up is that retained earnings comes down. Dr. Luke treated patients and received $1,500 cash at the time of service. Again, you treat patients, you receive cash, so cash goes up by $1,500, service revenue goes up by $1,500. You will notice in the same way that expenses make retained earnings drop, service revenue makes retained earnings go up. The business paid office rent of $1,000. Well, paid means cash is going down, and then of course office rent expenses here will go up. Notice $1,000 cash down, rent expense has the effect, even rent expense is going up, but that has the effect of declining retained earnings. Expense is bad, they drop retained earnings. Revenue is good, make retained earnings go up. Notice up here in liabilities and stockholders' equity, we don't have the expenses. So we're being told, basically what we're being asked with this exercise is what effect does this have on retained earnings? Business paid $500 on account. When you pay on account, notice it's pay on account. That means the on account is going to be an accounts payable. If you receive on account, that means accounts receivable is going to be impacted over here. but this is not received on account, this is paid on account. So what you'll see is cash dropping $500 because you paid $500, and you'll notice that accounts payable also drops. So it's kind of a good. Your cash went down, but now you owe less. Here's your total, $155,500. Notice how it balances to liabilities and stockholders' equity. Very soon, when we start doing actual account entries in the next chapter 3, you'll see us start to delineate these. We won't show the direct effect of retained earnings. We will actually book service revenue. We will actually book interest expense. The purpose of this exercise is to show you what the effect of these different accounts, these accounting transactions have on these accounts, and how assets and liabilities and stockholders' equity have to stay in balance. If something drops here, it's going to either have to go up on the left-hand side or down on the right-hand side. If something goes up here, it's either got to go up, and then this is kind of a weird one because it's two sums here. If the assets go up by 2,800, that means something on the other side has to go up by 2,800 times 2. Just want to show you this real quick. Something that's really important is this paid on account. When it's paid on account, you know you're going to hit an accounts payable. If it says received on account, that means receivables is going to be affected. Anytime you pay, you know that cash is going to go down. Anytime you receive cash, it's going to go up. Just balance out the entry with accounts receivable or accounts payable. I hope you found this useful.